We know the grid is undergoing massive change, which creates massive opportunities for local energy. The Energy Changemakers podcast offers rich conversations with industry leaders to help you and your company capture opportunities to build a decentralized grid. I'm your host, Elisa Wood. Welcome to the Energy Changemakers podcast. Hello, Eliot. I'm just so excited to have this conversation with you today because every time you and I talk, you're opening up my eyes about some really interesting things, especially on this topic of energy abundance, which everybody seems to be talking about lately. And you've got some really unique perspectives. Just real quickly, though, before we start getting into our topic, just give our audience a little bit of information about who you are and what you've done.
Well, first of all, I'd like to thank you for the opportunity to come on your podcast. I've been a big follower of what you've been doing over at least the last 20 plus years. So it's really an honor and I sincerely appreciate it. Really quick, my background, former captain in the Marine Corps. I started my first company during the dot-com days, building of all things data centers, which is now a very popular topic. And then 20 years at General Electric, where I led the development of GE's Microgrid solution from a concept through RD&D across the valley of shadow death and ultimately into a business. So I've been very much focused over my 20-year career at GE in transforming the markets, particularly around the topic of clean energy, resiliency, and distributed energy.
And you were so impressively one of the very early people in the microgrid space, and that's how we met. So right now we're seeing that a lot of people are looking for ways to make energy more affordable, to put it as simply as possible. You know, a lot happened in 2025. There were incentives and grants and all kinds of things lost. And there's definitely a movement within the distributed energy business right now to find innovative ways to make things more cost effective. And I really wanted you on the show because I think you've come up with one of the most innovative I've heard so far. We were talking a little bit ago about the whole abundance agenda that Ezra Klein has been popularizing, and we had a podcast about it recently. And you have a really interesting take on this because energy abundance is typically talked about in terms of we need to build more stuff. But you're looking at abundance in a different way in terms of finance. Tell us about that.
Well, as a student of history, I always look to the past to help inform how we can do things in the present. And so what were similar situations where we had one example is I like to use is the information and knowledge that resulted from the printing press and the Renaissance. You had the institutional infrastructure, you had knowledge, you had the church, you had governments, and then you also had capital. But these two things were abundant in and of themselves, but the ability to integrate these abundances made them stranded abundances, if I could just coin a term. And it wasn't until the ability to interconnect the stranded value, which is knowledge, information in that example, and stranded capital, which then freed it up and democratized access to knowledge. And now buying books, even back then, became a lot simpler. And look at the current permutation of that in our modern information age.
AI, and so much coming at us.
Information is not scarce anymore. It's abundant and cheap.
Mm-hmm. So how does this then relate to energy and distributed energy in particular?
Yes. So I look back to the early days of microgrids and DERs, early 2000s timeframe, when there was a big push to begin to integrate the different value streams that these energy systems put together. We know about how we could stack DERs together, integrate energy management technologies to optimize supply, demand response. All these different value streams, the industry built the capability to put together and integrate, okay? The one thing those value streams lacked was access to capital. Now, these value streams could come in the form of resiliency, reliability. There could be indirect or avoided cost value. It was always very difficult to articulate how you can connect that value to capital. And the primary reason was because capital didn't trust it. For example, we see many incentives out there. Let's use the IRA as an example. And we both know microgrids and DERs. But when the IRA was passed, there was incentives that would give microgrid projects up to 60, 70% of the CapEx, okay, if you stack them correctly. And microgrids certainly know how to stack DERs, but no one took advantage of it because the capital didn't trust it, or they would severely discount those value streams. And so
Did they not take advantage of it because they didn't trust it would be there when they needed it? Or what why didn't they trust it?
it was friction. It was friction, right? We talked a bit earlier about in Ezra Klein's book, Abundance, the need to remove the friction to build, right? But what we were seeing was the need to remove the friction to finance. So it was either complexity or it wasn't, will it be there or won't be there. People didn't really, and the technology, frankly, wasn't really there to create the trust to stack the different value streams that were being created by the technology. So you would have things like the 179D building energy efficiency tax incentive that would give $5 a square foot for energy efficiency, but you weren't able to take that capital, which would come 3 years after the project's done, and integrate it into project finance. And so those inefficiencies have significantly prevented the value streams that DERs have created over the past 20 years and essentially created stranded value streams.
Interesting. Yeah, I've heard that discussed at conferences quite a bit, where we would have people in finance on a panel along with developers, and the finance people would say, "Hey, we get it, we get it, we understand resilience, yes, 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 but we really don't know how to monetize these value streams that you're talking about here." So I see what you mean about that's a great description. They were stranded. The value was there, but you couldn't apply the value in any way.
Right. The value is there and the capital is there. I mentioned the capital for the 179D tax incentive that's highly underutilized. It's too complicated. People don't understand it. They don't deal with it. We talk about the investment tax credit that now is even more complicated and even more risky, but there's still significant value out there. For example, the ITC doesn't sunset on heat pumps. And heat pumps are a very important program for affordable housing, K through 12, for many programs throughout the United States. And that incentives brings about 50% of CapEx to the table. Plus, you can stack. You can put 179D in state and local incentives. And pretty soon you have a story where you can conceivably do 70% of the CapEx, but no one's taking advantage of it, particularly after the passage of one big, beautiful bill. We're talking to developers out there who are deploying tens of millions of dollars of heat pump programs, and they're not taking advantage of it. Why? It's too complex. It's too risky. There's stranded value for both capital and both the value these projects would bring. And that's what I
See,
would call stranded abundance right there.
yeah, interesting. It's not enough to just bring the capital to the table. You have to make it really clear how the capital can work at the table, right? That's seems to be the problem we're having.
Well, the capital has to trust the outcome. That's the key. And that's the problem that we were trying to solve when I was at GE. And when I say we, me and a couple of my colleagues from GE Capital, that began Realize over 5 years ago, because we recognized that technology was changing in finance. And specifically, we're talking about decentralized finance, Web3 technology, the ability to integrate smart contracts into automation and settlement, blockchain, tamper proof, trust, the ability to take trusted data and then integrate it into trusted outcomes that capital can then utilize. And that's a fancy way of saying that what we're trying to do is essentially to monetize the data, which has been the number one challenge, whether it's smart grid as a service, how do you monetize the data? And the way you do that is you have to take it and convert it and transform it into investable assets. That's the key.
When you say you have to translate the data,
Mhm.
what data exactly are we translating?
The information, what we're trying to connect is the value stream with the capital. We'll start with
Mhm.
that idea. Okay. So the value stream is, in this case, let's use the Inflation Reduction Act ITC tax credit, which you can get direct pay even today, safe harbor, all that. So that value stream, the capital doesn't trust it. It's too risky. As we know today, many people are not taking advantage of that tax credit. However, if you take the compliance data and integrate it in such a way that it's trusted, where you then integrate it into insurance. So think like, you know how telematics and fleet vehicles are integrating IoT devices into insurance policies to automate insurance? It's the same concept. If you take that data and you create a trusted, tamper proof framework for it, integrate it into policies, that policy can now remove that risk off the table. So if there's a recapture risk for 50% of the capital of the project, and we can take that data and make it into an insurable asset, we now can remove that off the balance sheet. And now we can do 2x or 3x of funding projects because capital trusts the data. And now we can integrate the stranded value stream with the stranded capital.
Very interesting. So can you take us through like an actual project of how this might work?
Yeah, I sure can. But I'll first start with a quick example. And this is an important example. I'll use the example of how renewable energy certificates went through this journey already. It's something we all, I think, can understand. Today, renewable energy certificates are connected into the market. They're clearing into market action. The reason they're doing that because there's a standard framework, there's trust created in there, and now that information, that data is now in a framework where RECs are into the market. What's now evolving in that market space is something called granular certificates, where if you can match hour by hour whether a battery that's discharging was charged by a solar versus a coal plant, you now can have a higher value REC or granular certificate that the market is demanding. And that's how the market has evolved that data into a capital market so it can clear. All right. That's a
Mhm.
previous example. A perfect example right now is the one I just gave you. Let's say you have a $100 million state heat pump program to deploy heat pumps in affordable housing. And we know we have these value streams of the 50% ITC, which doesn't sunset. We know we have value streams from 179D, which will sunset or may not later on. We know we have state incentives. And what we want to be able to do is create a framework where all these value streams can be structured in such a way that it doesn't get discounted by capital and can also eliminate the risk that's currently exposed by a developer or asset owner. If we could take that risk off, I then can go to that developer I mentioned earlier saying, I'm not going to put the ITC 50% for heat pumps because it's too complicated and it's too risky. Now we can take that off the table. And what was a $100 million program that may have supported maybe 10 million square feet of heat pump programs is now a 2 to 3x program that also can reinvest capital in because you have trusted outcomes and data that is now made into an investable asset.
That's very interesting. And so this is the work your company is doing now, correct?
Yeah, that's correct. We recognize earlier on, and this is very important to this long journey of how we achieve energy abundance. But what's happening in the market, aside from me talking about the decentralized finance, technology, automation of smart contracts, is that there's a significant push and an investment focus in an alternative investments. Okay. Clean energy is a alternative investment. Renewable environmental certificates are alternative assets. These value streams that I talked about, tax credits or whatnot, are alternative investments. So the ultimate unlock to this journey to energy abundance that I see in the very near future, which I think is very achievable, there is hope. Okay. And I think the opportunity is now where we can then take advantage of that transition of investment into private markets, I think tokenization of private markets, which will now require granular asset transparency to create that liquidity. And right now, what we're doing is creating the framework to take that data and make it investable, to take that risk off the table, to scale, very basic project finance and structured finance. But ultimately, when that pool of stranded capital, that institutional capital that now wants to invest into private markets, when that stranded capital gets integrated to these stranded value streams that we're talking about in the framework of decentralized finance and tokenization with trusted granular data, that's when the liquidity will occur. And that's a trend that's very much happening right now. You just read Larry Fink's investor letter at the beginning of 2025, where he talks about tokenization, private market investments. It's happening now.
This is interesting. So if I am a developer, private energy developer out there, microgrid, whatever, how do I begin? I'm hearing theory, it makes sense to me. How do I begin instituting this in my project?
The current burning need is safe harbor with the OB3 regulation. We're seeing two things. We're seeing developers in the general clean energy market, but particularly in what I would call the mush market, universities, housing, all that. Either they're taking the risk that their direct pay ITC will come in 2 years, whereas in the past they had friends in DOE, maybe not so much now, or they're taking the risk off the table by not taking that incentive. So what we're offering them right now through our technology platform, which creates that trusted environment for the data, which is integrated into insurance partners. Again, think telematics for clean energy, just like telematics for fleet vehicles. We're taking that data and integrating it in such a way that the compliance data enables them to price the risk properly for investment tax credit recapture. So the first thing we're offering right now, it's not the only thing, but the primary thing that we're seeing the main need for is getting that ITC recapture risk off your table. We're seeing school districts go after projects that they're trying to safe harbor with tens of $1 million of ITC direct pay that they're hoping they'll get. And it's going to be the county that's going to be end up liable to the taxpayers. So what we're doing is trying to take that risk off the table right now. So if there's a developer or an asset owner right now who wants to quickly solve for that, that's step one. But then it gets better after that, because ultimately what we're doing is stack, just like we stacked in the value streams with microgrids and DERs electronically. We're doing the same thing. We're automating and stacking the financial value streams to maximize and integrate the value streams with the capital pools.
Fascinating stuff. So when we talk about abundance and we talk about the fact that the US isn't building enough, and we're talking about the idea that part of the reason for that is that we have this stranded investment side, this stranded capital side. I guess the question I want to ask you is, how much of a difference will this make? How much is this stopping us from achieving abundance? Because we always hear about abundance in terms of, as we talked about in the beginning, you can't get your permits fast enough, you can't get interconnected fast enough, the supply chain is holding you up or something like that. I'm trying to sort of gauge like what this means to the market. If we can get this right, how much closer can we get to achieving that vision of abundance?
I think the vision of abundance has to date been framed correctly in terms of the areas that, let's say, institutional, government, political entities can affect it to. And that, I think, could be encapsulated by the objective of removing the friction to build. And what we're adding to that is the other side of the coin is removing the friction to finance. The capital's been there, the desire's been there. You have many investment institutions trying to, do the right thing with, maybe ESG goals, but the capital friction is not been addressed. Even with, like, say, something like carbon credits or insetting, It's very difficult for organizations to value that. They don't trust it. They don't know if it's a trusted thing. But once they have that trust, and that's the key, once you have the trust infrastructure to connect these stranded abundance pools, stranded value, stranded capital, then that's how you address the functional scarcity that you're seeing right now. And again, to me, that's an historical thing. I'll just give another quick analogy because I think history is so important to help us understand what we're seeing. So one example is the gold rush. On one end of the continent, you had a lot of gold. On the other end of the continent, Chicago, New York, you had a lot of capital. Now, I'm in Pittsburgh, so we had capital in Pittsburgh as well, Vin Carnegie. So we had all these things, but the challenge was you couldn't get the gold. They were in powder and, there was no infrastructure to connect the two. So you had, for example, Wells Fargo. What did Wells Fargo do? They created the infrastructure to connect the two, a stagecoach network. They created the ability to take the gold, pay it in cash. They brought the cash for the gold and then, put it in such a way to get transported back safely. They created trust and they created the ability to do the value exchange between two stranded abundance pools, one being the stranded value and the stranded capital. This is precisely the same type of concept that we're implementing here, which is why I'm very excited to hear that podcast you had recently on abundance, because I think what we're trying to solve here is the other side of that coin, removing the friction to finance.
And removing the friction to finance, it seems to me, is preliminary, right? Because if you can't finance it, you can't build it, you can't interconnect it, you can't do anything, right? This is the first step.
You need both, right? You need both the regulatory, the will. I mean, without a post office, without the infrastructure, the army back then to protect or maybe the better analogy is the earlier one I gave about the democratization of information and knowledge. You had the infrastructure in place. You had words, you had institutions, you have legal things. All that exists in the same framework today with the government policies and the initiatives that you are trying to support and drive. You need both. It's two sides of a coin. And when you look at history and see how these stranded abundance pools were connected, we have something to point to us to show us how we can learn from the past in order to achieve this goal of energy abundance.
And the ultimate goal is democratization of energy. So, if I understand you correctly, what you're saying is when we have the ability to move that stranded capital, engender the trust, and move it to where it needs to go, then we have abundance on the other side and a better chance of getting the solar panels out to everybody or getting the microgrids out or whatever it is that is going to bring more of that energy democracy to the public. So it's not just abundance in itself, I guess is what I'm saying, is there's an end goal beyond abundance. It's not just build a lot of stuff, it's achieve something else.
Yeah, I like the idea of a democratization of energy. We need to look at it two sides of coins. You're talking things and assets, which is that, okay? And then we're talking finance. So we talk about democratization of finance. So one outcome of being able to do that is not only you can unlock these stranded capital pools, but the largest stranded capital pool is people like you and me and your audience. What if you were able to have a local community energy project that was structured like a tokenized environment where you can invest into it, but that it's trusted and all the value streams are there? We're unlocking another pool where we can democratize finance into private market assets. So it's important to look at this as two sides of the coin. I said earlier, abundance does not emerge when assets exist. It emerges when the value streams clear into the markets. That's both sides of the coin. So it's not just about friction to build, it's about friction to finance.
I like your vision.
It's our vision.
Well, hey, thank you. This has been a really fascinating discussion. I appreciate it very much. And I think we're going to be talking about this a lot in 2026.
Yes, it's a very exciting year. It's a year of opportunity. And with the recent passage of the One Big Beautiful Bill, there's no need to be crying into your beer. There is opportunity here. It's a tipping point in the industry. Clean energy is tipping it to the automation of data and insurance and assets. we're at the forefront of it. It's a very exciting time. So I'm glad to be working with you in this journey together to achieve energy abundance.
Wonderful. Thank you so much, Eliot.
Thank you very much.
Thank you for joining us today on the Energy Changemakers podcast. I hope today's conversation has inspired you to think differently about the role of distributed energy in our society. If you enjoyed this episode, please subscribe to our podcast on your favorite platform and consider leaving us a review. You can help us shape the dialogue around energy. Go to energychangemakers.com, subscribe to our newsletter, and join our community. Together, we can make a real difference in how quickly we can make our grid local, equitable, and clean.